Good day, students. Once again, this is a question on the weighted average cost of capital topic that I will be recording. Very few marks out of 10 marks, but very crucial to understand. There is a lot of calculations that need to be accounted for, honestly, for this 10 marks. Some people argue so. Now, it starts with the requirements as usual, and it says determine the optimum or optimal capital structure of S&S Ltd to finance the new equipment. Assume that a corporate tax rate is at 28%. So now, meaning there is an investment opportunity for the new equipment, which we don't know yet the cost of the equipment, and this equipment must be financed through different or various sources of funds. Therefore, now we need to identify the best one that will suit the financing of this equipment at the minimum lowest cost of capital. So now it says Simpiwe is a financial manager of S&S Ltd and has been instructed to find a suitable funding instrument for new equipment that needs to be purchased at a cost of 375,000 rands. This is the equipment that we need to buy, which we need to look for the different sources of fund to make sure that we buy this equipment at the minimum or the best lowest source of fund. It could be the combination when necessary, where you combine different funding instruments, maybe data, equity, debentures. It further says that he has identified two possible funding instruments, namely the loan from the bank and the issue of shares. So there are two sources of funds that are available to fund the purchase of the equipment that is costing 375,000. First one is the loan from Capsi Bank, and the issue of shares, of which the issue of shares will is likely to be categorized as equity. In the case where the shares issued are not redeemable, because when the shares that have been issued are redeemable, therefore now they become debt, not equity. But the assumption will be that these shares currently they are equity, unless it was stated that they are redeemable. He has discussed the loan option with the bank manager from Cape Bank and also has discussed with a few investors that are interested to taking up some of the shares in S&S Limited. So an investigation has been done to assess the best method or source of fund instrument to finance this equipment that is new in this business. The following information is available based on the outcomes of his discussion. So this is the results of the meeting that he held with the two investors, being the bank and the investors regarding the shares that are expected to be issued. Cape Bank, these are the discussion outcomes. The bank manager of Cape Bank has agreed to grant a loan up to 100%, meaning the full amount of 375,000 is available to be borrowed from the bank in order for us to purchase the equipment that is costing 375,000 rands. The loan will be granted in multiples of 75,000 rands, and S&S Ltd can decide how many multiples they would like to borrow from the bank. Meaning, if it is in multiples of 75,000, it means 375,000 divide this by 75,000. It will give us the number of 75,000s that are inside 375,000. So 375,000 divide this by 75,000 tells us that there are 575,000 inside the 375,000 rands that can be borrowed by S&S or Simpiwe on behalf of S&S Ltd in order to finance this new equipment. Then after, it further says that for a 100% loan, the risk is higher and therefore the interest rate charged for the 100% loan, take note, only if the loan is borrowed 100%, meaning if the full amount of 375,000 rands has been borrowed, therefore the interest rate will be 17.5% before tax. Remember, loan is debt and debt attract interest. Remember, interest on a loan will be recorded in the statement of profit or loss as a finance cost, meaning as a deduction allowed by SARS. So if that is a deduction, meaning now there is taxation implication that need to be taken into account whenever you deal with the debt as a source of funding instrument. So now this is before tax. We still need to take into account the tax which was provided to us at the bottom, that the tax expense is assumed to be 28%, meaning the after tax will be 72% after tax. In other words, we say 100 minus 28, meaning the company will only pay 72% because 28% will be deducted as a tax, will be deducted as an expense in the income statement. Then after it says for every 75,000 not taken up by SNS, the interest will decrease by 1.25% as the risk to the bank is reduced. So now meaning if the company decides to borrow 300,000 rands, just a random example, if the company decides to take only 200,000 rands from the bank, it means they will not be taking 75,000 rands. Therefore, now for this 75,000 rands that is not taken by the bank will reduce the interest from the bank by 1.25, meaning it will be minus 1.25% times by 1, because there's only one 75,000 rands, not 175,000 amount. There's only 175,000 rands that has not been borrowed, meaning the loan in the bank will decrease by 1.25% because there is a 75,000 rands that has not been taken by this company in order to finance this project. So that is what it means. Let me just explain a little bit further. That means if the company decides to say 375,000 rands minus 75,000 rands, I want to remove two amounts of 75,000 rands. If the company decides to borrow 225,000 rands, meaning they are not taking 75,000 rands twice, meaning in other words, the interest will then decrease by 2 times by 1.25. And if we say 2 times that by 1.25, it will give us the amount by which the loan in the bank will be decreasing. And 2 times by 1.25% will be minus 2.5%. It will be minus 2.5%. So now this will be the percentage that will reduce the loan, and this will be the percentage that will be reducing the loan at the same time. So now there are these different alternatives that can lead to the reduction of the interest. But the question is, if the interest can decrease by 1.25 for every 75,000 that is not taken, where will the company take that 75,000 rands? Obviously from another source of funding, which was the issue of shares being equity. So now we go to the issue of shares to prospective investors. They are not yet investors, but they are prospective investors. Issuing of new shares to prospective investors. Investors are very keen to invest in SNS Ltd. And after discussions, Simpiwe identified enough interested parties to take up 100% of the investment amount needed. So there is an opportunity to take this amount through the bank, because the bank is willing to fund us with 100% of the purchase price of this new equipment. And the interest rate of the bank is 17.5%. And at the same time, investors through the issue of shares are very keen and willing to invest or to give the entire 375,000 rands. Therefore, now the question is, which option will best suit the company in order to opt for that option to buy this new equipment? Now, not being ignorant or not forgetting that for every 75,000, just I'll be using this interchangeable because they are they have to be integrated. It's one option that we need to choose the best optimum funding instrument. So now remember, for one, whenever 75,000 is not taken, the interest in the bank will decrease by 1.25. So it's not like we will be paying the 17.5%. It will depend how many 75,000s do we take from the funding through the CAPC bank. Then now at the same time, investors through the issue of shares, which is equity, are very willing to give the entire amount of 375,000 rands. But the question is, how much do they want as a return? Then now it says, if everything is financed through equity, the equity holders will require a return of 15%. Okay, that is looking good. Now it's 15%, and we can see that 15% is less than 17.5%. But we still need to look at other factors regarding the discussion that was done by Simpiwe to these prospective investors. If portion of the funds are generated through the loan, the investors are of the opinion that it will increase their risk and they will therefore require a greater return on their investment. So now, meaning if the investors, if the amount of 375 is not fully funded by the issue of shares, therefore now these investors are of the opinion or of the view that the risk will be increased. And in financial management, we say the higher the risk, the higher the return. So obviously these investors will expect a better higher return than the 15% of the return that they want if only the full amount is funded through equity, which is the issue of shares. Now let us read the last sentence. It says they will have, or they have agreed, they will require an additional return of 0.5% for every 75,000 rands that is borrowed from the bank. Meaning for every amount of 75,000 that is not funded through equity, therefore now there will be additional 0.25 that is added on the return that the prospective investors expect on their investment. So now, on the other hand, we realize that from the bank perspective that for every 75,000 that is not taken in the bank, the interest in the bank will decrease by 1.25, meaning decreasing that 17.5%. However, with regard to the issue of shares being equity, it is the other way around. For every 75,000 rands that is not taken, meaning if the SNS company or Simpiwe decide not to take the entire 375 through the issue of shares, for every amount that is not funded through the equity, therefore now the return of the investment will be expected to increase by 0.5%, 0.25%. So now we have these options that we need to find which best funding instrument or capital structure will be the best to finance this new equipment. The question still remains. So now here are the options, just again to bring more clarity and more emphasis or more meat on this aspect. Meaning, if we decide to borrow 300,000 or we decide to finance this equipment, in other words, 300,000 through equity, assume that this is equity. So if this is equity, meaning we did not take the entire 375,000, meaning there is 75,000 that is not taken or funded through equity. Therefore, now we will have to say that 15% plus 0.25%. Then if let us say we decide to borrow 225,000, and I think now you know that 225,000 is deducting 75,000 two times. So now if we decide to take 225,000 rands through the issue of shares, it will mean another amount will be from the bank, affecting the interest of the bank for every amount that is not taken in the bank. So now that will mean it will be 0.25 plus another 0.25. That will be how we'll be increasing our interest, meaning it will be 0.25 multiply this by 2, meaning we'll have to say 15 plus 0.5. That will lead us to 15.5. In the case we opt for this option of only taking 225,000 rands through the issue of shares being equity. Now let me go and read the requirements. So now we have to look at all the options where the weighted average cost of capital will be the lowest, or we have to look at all the options and calculate the weighted average cost of capital for each of the options. Then after we choose the best option that will have the minimum or the lowest weighted average cost of capital being our WACC. So now let me then proceed in response to this question. Remember that the corporate tax rate is 28% and equity does not attract tax for the purpose of calculating weighted average cost of capital. So now I have provided the table in terms of the simplicity in response to this question. Now there is the first option. Remember, I did make mention to you that the amount that we want to borrow is 365,075,000 rands, meaning the amount that we need to raise. And this amount is in multiples of 75,000 rands. These are the multiples of this amount. And we said there are 5 options, or there are 5 options of 5 multiples of taking this different, or this 75,000 rands from the 375,000 rands. So there are 575,000 rands in 375,000 rands. So now meaning out of these 5, we need to start with the debt and equity for all of them. So now meaning the first part, remember this is option, this is capital structure being debt or equity. Then this will be the weighted average cost of capital. Then you have the portion of the capital structure, required rate of return, adjustments. Adjustment here, this is when there will be a decrease in the interest or an increase in the interest. That is the adjustment, where the interest will increase or the return that is expected by the investors will increase, or in the bank will decrease because of the amount of 75,000 that is not taken. That is what the adjustment column is all about. Then after we have the total rate of return before tax, then the rate of return after tax, then this becomes the weighted average cost of capital after tax for each of the funding instruments. So now let us start with the first option. First option is that we can take 100%, 5 over 5. Remember, 5 over 5 meaning we take all the 75,000 rands through our debt. And if we do that, it means the weight of our debt will be 100%. Therefore, now that means when it comes now to equity, we will take nothing from equity. This is the first option. Out of the 575,000 rands, we will take nothing from equity, but we take 100% of debt. Then we need to see what will be the weighted average cost of capital in this scenario. So now this is 0% in terms of weight regarding equity. Then the return, remember our return still remains as 17.5% and 15%. The return of the loan, in the case the loan is taken all of it, meaning in the case where we take the entire 375,000 rands as a loan, this will be the interest 17.5%. Therefore now that will be our rate of return 17.5%. So now remember, if we take the full amount of the loan, the interest on the loan will not decrease, meaning the decrease will be 0 times this by 1.25%. Then if we do that, meaning the loan will decrease by, the interest on the loan will decrease by 0%. Then at the same time, remember it's said when it comes to equity that we have return that the investors expect to be 15%. But for every amount that is funded through the loan, let me go there once again. For every amount that is funded through the loan, they have agreed that they require an additional return of 0.25 for every 75,000 that is borrowed from Cape Bank, meaning for every 75,000 that is not taken through equity, there will be an increase in the expected return of the prospective investors. So now, meaning in this case, we did not take any of the 75,000 rands, meaning all the 575,000 rands have been taken through the loan in the bank. Therefore, now meaning the shareholders' return is expected to increase by 0.25%. So now this will give us 1.25 as the expected increase in the interest. Let me do that. 0.25 multiply this by 5, because we expect that all these 575,000 rands will not be taken through the issue of shares but through the bank. So now the risk of the investment will increase. Therefore now this will end up increasing the return to 16.25%. This will be the increase in the percentage. But the question is, why are we increasing this? Because there is nothing that has been borrowed. It's only the matter of just applying the principle consistently. Otherwise, there's honestly no necessity for us to do this. But you'll see it a bit later on when we do the work. Therefore, now this will be 5 times this by 0.25, meaning our return on this investment will be 1.25% expected to increase by that amount. So now when it comes to the total rate of return before tax, it will be the increment amount or decrease amount plus the rate of return, or plus the return. Therefore, now in this case we have 17.5 plus 0. Therefore, now meaning the return before tax will still remain as 17.5%. And here we have 15% plus 1.25. This will give us 16.25%. This will be the return if all the amount of the loan, if all the amount of this investment or this new equipment project is taken through debt. Then now we go to our return after tax has been accounted for. Remember, debt does attract tax, but equity does not attract tax. Therefore, now meaning 17.5 times this by 0.72, meaning after deducting 28%, we get our after tax as 12.6. Our after tax is 12.6%. And here we will have no after tax, but it will be 16.25% as the return after adding the increment of 0.5 by the number of 75,000 rands that were not taken through equity but taken through debt. Then now we go to the weighted average cost of capital. Weighted average cost of capital, it is the portion of the capital structure minus the cost of the return after debt, after tax has been accounted for. So it will be 100% times by 12.6, that will give us 12.6%. Then the weight is 0 times by 16.25, that will give us 0%. So now meaning our weighted average cost of capital for this source of investment or part of this instrument, it will give us 12.6%. So now this will be the first option of the funding instrument. Then we go to the second option of the source of fund. Second option of funding this new equipment will be, now we're no longer having to take the entire 5/5, meaning all of those 75,000 through debt. Let us look for the second option, where we only take 4 of them, meaning 4 out of 5, and see how are we going to, what will be our weighted average cost of capital on that, our work. Then we say, if we say 4 of those 75,000 divided by 5, meaning it will be 80% of debt. And when it's 80% of that, meaning one of them must be taken from equity. And when you take one from equity, meaning the weight of equity will be 20%. This must always be 100%. Remember, the return we write the original return before the adjustments have been taken into account. The required return on this investment is 17.5 on the loan and 15% on equity. Therefore, now we do an adjustment once again. Remember, in this case, when it comes to the adjustment, we are calculating from the debt perspective. And whenever there is one amount of debt, meaning 75,000 of debt that is not financed by the bank, the loan will decrease by 1.25. So now meaning it will be 1 times by 1.25%, meaning the interest on the loan will decrease by minus 1.25%. That is the amount by which the interest on the loan will decrease by. But remember, for every 75,000 that is funded by the bank, the interest on equity will increase by 0.25. Now the question is, how many 75,000s are taken by the bank? There is 4 75,000 that are taken by the bank. There's only 1 75,000 that is taken through equity. So now meaning it will be 4 times by the number of 75,000 rands, or which is plus, it will be 4 times this by 1 or 0.25%. So now meaning the equity will increase by only 1%. Equity will increase only by 1%. Let us check that. We have 0.25 multiply this by 4, meaning equity interest will be expected, or return on equity will be expected to increase by 16%. So this will be 15 plus 1% and 17.5 minus 1.25. So let us just do those calculations. 1 plus 15 will give us 16%. Remember, equity does not attract interest. Then we have 17.5 minus 1.25, meaning it will be 16.25%. This will be our cost or return on the investment before tax is accounted for. I just want to go there and emphasize on this working that I've just done. Remember, I said they have agreed that they will require an additional return of 0.25% for every 75,000 rands that is taken from the bank. Now, and I said in the second funding, we are taking 4 out of the 5 through debt, and equity we are taking 1 out of 5, meaning there is 4 of the 75,000 that is borrowed from the bank. So now hence I'm saying 4 times this by 0.25%. So now that gives me the portion that will be an increase in the return on the equity perspective. So now, not forgetting or just reminding you once again that when it comes to the loan in the bank, for every 75,000 that is not taken, there will be a decrease in the interest on the loan by 1.25%. So we need to count how many 75,000 rands are not taken by the bank at a specific point of the funding combination. Therefore, now we look at that and we make sure that we reduce the interest in the bank by the respective figure. So now we continue to the same calculation. Then now we apply the tax effect, which is 16.25 times by 0.72, and this will give us 11.7%, and this will still be 16%. Nothing will change because equity will not attract any tax. Then now we have to calculate the weighted average cost of capital. Remember, WACC is the weight times by the return after tax has been accounted for. So now it will be 16 times this by 0.2, then we get to 3.2. This will be 3.2%. Then the first one, 11.7 times this by 0.8, which is 80%. 80% being this 80%. Therefore, now this gives us 9.36. This gives us 9.36%. And if we add these two, we will get to the weighted average cost of capital when there is 80% of debt and 20% of equity. Therefore, now 9.6 plus 3.2, it will give us 12.56%. 12.56%. So now this will be the weighted average cost of capital at the combination of 80% of debt, then after 20% of equity. Then we go, remember, we will be comparing our weighted average cost of capital and that WACC cost of capital and the next one, and we find the lowest, and the lowest will be the one that we choose or we recommend the company should opt for. Then the next funding instrument will be that of us having to take only 3 of the 75,000 out of the 5 through debt. And let us look what is 3 out of 5 means. 3 will mean we can take 60% of debt. Therefore, now meaning we take 2 out of the 5 through equity. 2 out of the 5 will definitely give us 40% because the total weight must always add up to 100%. So now that means we still keep the return on the investment as 17.5%. That does not change. And 15%. Remember, this is before the adjustments have been taken into account. Hence, now there is an adjustment column. Then under the adjustment, we say now, remember, what is the deal regarding debt? Debt says for every 75,000 that is not taken in the bank, the loan will decrease by 1.25%. So now, if we took 3 of the 75,000 only, meaning 2 is not taken from the bank but is taken through equity. So now meaning the 2 that is not taken is the one that we want. It will be 2 times by 1.25%, meaning it will be equal negative, looking at the answer now immediately. 2 times 1.25, meaning it will be 2.5%. So now meaning 2.5% will be the percentage by which our interest in the bank will decrease. Therefore, now we can say minus 17.5 and to see how much. So now we can see that the interest in the bank will decrease to 15% if we only take 60% of debt, meaning 75,000 times by 3, or if we take if we take that, it will decrease the loan to 15%. Then now let us look at equity. Remember now, equity is a plus. For every 75,000 that we are not taking, that will increase the return on the equity side. So now, if we took only 2 out of the 5, meaning we took 150,000, there's other 3 of the 75,000 rands that are not taken. And for every 75,000 that is not taken, the return on equity is increasing by 0.25 for each of them. So now meaning, how many did we take? We only took 3 under equity, meaning we took 2 under equity, meaning 3 under debt. 3 is not taken but borrowed from the bank, which is debt. So now meaning 3 is not taken. So now in that 3, we say 3 times this by 0.25. This will give us the number of the total amount that will, or the total percentage that will increase the return on equity. Therefore, now it will be 0.25 times this by 3 because other 75,000 rands are taken through the loan. So now this will be 0.75%. So now in this 0.75%, just to make sure that there is enough space, then it will be open brackets 3 is taken through the bank, and for every one that is taken through the bank we will increase our return on equity. This will be 0.75%, by which equity will increase. So now 0.75 plus 15, it will give us 15.75. So now 15.75. Just to remind you once again, I don't want to leave you behind. Remember, it said they have agreed that, as to maximize, they have agreed that they will require an additional, take note, an additional return of 0.25 for every 75,000 that is borrowed from the cap bank. So now where we are saying for every 75 taken from the bank, we need to increase our 15% of the return on equity. Now in this case, look at that. How much was borrowed from the bank? We borrowed 3 of the 75,000 rands. Previously we borrowed 4. Hence we said 4 times this by 0.25. For every 75,000 borrowed from the CAPS bank, the return on equity is going up by 0.25%. So now that is what is very crucial in this question. Then now we calculate our tax effect, which remain the same regarding equity because equity does not attract tax. This will be 15.75 times by 0.41 to multiply it, and I have my 6.3% as weighted average cost of capital for equity. In the case we borrowed 2 out of the 5 of the 75,000 through equity. Then after we have 15 regarding the loan times by 0.6, and this gives us 9. It gives us, I can confirm, first after tax we have 15 times by 0.72. This gives us the return after tax 10.8. 10.8 times by 0.6, which is the weight, remember. This gives us 6.48%. 6.48% plus 6.3%, we get 12.78%. So this is the third WACC in the third option that we might choose. The best one so far, 12.6% and 12.56, 12. The best one so far is still option number 2. We don't know. We still have other funding options that we need to look up at. Other options that we need to thoroughly look and investigate them. Now we go to the next one. The next one is when we decide to take only 2 of the 75,000 through the bank, and we take 3 of them through equity. Then if that is the case, meaning now is the other way around, we have less of debt and more of equity. Therefore equity becomes 60% now. Then things are turning around and they are going down, as you can see. The return on the investment still remains 17.5% and 15% before the adjustments are taken into account. Remember, if we take 2 out of the 5, meaning we take 2 over 5, meaning there is 3 of the 75,000 rands that are taken through equity. And remember, for every 75,000 that is not taken in the bank, the interest of the bank will decrease. So now we need to make an adjustment. This will be a decrease of how many? There will be 3 of them that will be taken through equity. And that 3 will be multiplied that by 1.25%. Therefore, now we get to know how much will be the total decrease of our interest from the bank. 1.25 times by 3, it means it will be 3.75. So now 3.75 is the percentage expected to decrease our debt. Then 3.75 minus 17.5, meaning the interest in the bank, we end up now with 13.7%. 13.75% before 13.75 before tax is accounted for. Therefore, now this will be how we allocate that. Then we multiply also it by the tax at the same time. Then we get 9.9%. 9.9%. And 9.9% times this by 0.4, which is the weight being 40%. Return on the investment, 9.9 times this by the weight of 40%. It gives us 3.96%. That is the weighted average cost of capital for debt where we only borrow 150,000 rands, or meaning 2 of the 75,000 through debt. Then now we go to equity and say for every amount taken through the bank or borrowed from Caps Bank, there will be an increase in the return. That's what the investor said, because they are running a higher risk. Therefore, now if that will be increased, the question is how many of the 75,000 rands are borrowed from the bank? 2 of them. There we do have 2 of the 75,000 rands are borrowed from the bank. And it was very, very, very clearly stated that for every 75,000 that is borrowed from the bank, the interest return will increase. They have agreed that they will require additional return of 0.25 for every 75,000 that is borrowed from the Caps Bank. Then the question is how many 75,000 are borrowed from the Caps Bank? We have how many of them? 2 of them. So now hence we will say 2 times by 0.25%. Therefore now this will be 2 times by 0.25%. It becomes 0.5, half a percentage. Half a percent will be an increment amount. Therefore now a percentage, this will lead us to 15.5% when it comes to the interest from equity return from the investors. 15.5%. That will be the increment. Remember, no tax implication, it remains 15.5%. Therefore now 15.5% will be 15.5 times by the weight of 60%, 0.6 times by 15.5, it gives 9.3. 9.3%. Therefore now the total of the two will give us the weighted average cost of capital plus 3.96. 13.26 will be the weighted average cost of capital. Still, this funding instrument is not best in comparison with that 5 or 12.56. We don't know if 12.56 will be the final best combination of the funding instrument or not. That we don't know, but so far it's still the best weighted average cost of capital that we need to consider. Option number 5. Option number 5, remember, we are reducing now our debt and we are increasing our equity. Previously, we had more debt. Just be mindful of that. Previously, we had more debt. All of it was debt. And we started to reduce debt legal, and we had 1 equity. Then we reduced debt legally, we had 2 equity. We reduced debt, then now we had more equity. Now, we are going down, reducing more of debt, and going to more of close to up to 100% of equity. Then now we say, okay, our debt now should be 1 option out of the 5. If we do that, what will happen? If we do that, that will mean debt will have a weight of 20%, and it means we need to take 4 of the 75,000 out of 5. Therefore now, meaning equity becomes 80%. Okay. Now, if equity is 80% and debt is 20%, that does not mean that the return is changing or the interest. The return is both 17.5 and 15%. It does not change before the adjustment are taken into consideration. Then after now we say, okay, next part we need to make an adjustment. When it comes to debt, for every 75,000 that is not taken we reduce the interest on the loan. Now, if we only took one of the 75,000, meaning 4 of them are not taken because they are taken through the equity instrument. So now, meaning we need to reduce our interest on the loan by 4 of the 75,000 that are not taken. Therefore, now, meaning it will be 1.25 times by the 4 of the number of the 75,000. In other words, multiply this by the number of 75,000 that are not taken from the bank but through the funding instrument being equity. Then now that will mean our debt interest or interest on the loan will decrease by a huge 5%, meaning this will lead us to 12.5%. It will be 12.5%. Then now we go to equity. Or let me just complete that line. Then now we have 12.5% and say 12.5% multiply this by 0.72, meaning after deducting tax of 28%, this leaves us with 9%. Then 9% times this by the weight being 20%. Therefore, now this will mean 9 times this by 0.2 will give us the weighted average cost of capital for debt when only 175,000 rands is taken, meaning only 75,000 rands is taken. Then after we go to the second part, which is equity. Equity, we have 4 out of 5, meaning there is 300,000 rands that is borrowed through equity or that is funded through equity. Therefore, now the question is, how many of the 75,000 are borrowed from the bank? Remember, that is the secret. How many of the 75,000 are borrowed from the bank? There's one only. If there's one, therefore, now it will be, for that one, we need to increase our funding instrument being equity by that 175,000 rands that has not been funded through equity. Therefore, 1 times this by 0.25, it gives us 0.25. So now we have 0.25, which is the amount by which equity should be increasing by. 0.25 plus 15 will give us 15.25%. That is 15.25%. Remember, after tax remain the same 15.25% because this does not attract tax. Therefore, now this leads us to 12.2%. And that 12.2% plus 1.8 plus 1.8 and adding 1.8, it gives us 14%. Still higher, more than 12.6 that I identified previously. The last option now is to take 0 debt and 100% equity. Last funding option is 0 debt and 100% equity. Remember, this is more of similar to the first option that we had in the beginning, where we had 100% of debt and 0 equity. So now we come to that last option. If we take 0 from the loan, it does not change that the interest on the loan is still 17.5%. Therefore, now it means it will be all equity. If we get all equity, therefore now the weight of equity becomes 100%. Then that will mean that we still going to say the initial interest before any adjustments is 15.5. Now, with regards to the loan, that will be a question of how then many of these 75,000 rands, by what percentage will our then interest on the bank decrease? The interest will decrease by 5 times because 5 of these 75,000 are borrowed, are not taken by the bank. So now it will be 5 times by 1.25, And if we do that, this will give us something like 6 point something. 1.25 times this by 5, meaning it will be 6.25, meaning we expect that the interest on the loan should decrease by 6.25. Then you say minus 17.5, this gives us 11.25. This will be 11.25%. Then the question comes again, why are we paying interest yet we borrowed nothing? It's not like we are paying interest, we just follow the principle of calculations. At the end of the day, there will be no cost of capital where there's no money that was borrowed. And when I say there will be no cost of capital where there was no money borrowed, you can see that in my first scenario, where equity was 0%, we still did the calculation as usual, but where we said now rate after tax times that by the weight, it gave us 0 because 0 times by a percentage. So now we just follow the principle or the protocol. Otherwise, we know that at the end of the day, this will lead us to 0 in terms of the cost of this funding instrument because nothing was borrowed. Then now we still have to keep that order and to say nothing will increase. Why? Because all the funding is done through the funding of equity. So now, meaning we only have 0 of the increase times by 0.25%. Therefore, now this will mean that we will be increasing the cost or the return on equity by 0. Then now, meaning the return before tax is 15, after tax still 15%. And with regards now to debt, we know that debt is attracting some tax. Times by 0.72, we get to 8.1. We get to 8.1. Then this will be 8.1%, and 8.1% after it has been multiplied. After it has been multiplied, we say 8.1 times by 0.0. Then this will give us 0. We times this by 0, then the weighted average cost of capital for debt where no money was borrowed will lead us to 0. Therefore, now that will be 0 because we have the weight of 0. We multiply the weight of 0 by an amount of 8.1, we get to 0. Then we come to now equity. Equity will be weight of 100% times this by 15. Therefore, now this will obviously give us 100%. Remember, it is 100 divided this by 100. It is 1 times by 15. This gives us the same as 15. So the weighted average cost of capital is 15%. And still again, the 15% is not the best funding instrument. Then now we have to come to the conclusion. And the conclusion, it says, based on the calculation, the best optimum structure is option 2. That will be what you conclude. Then now, and it's very important to make sure that you do your conclusion. This will be the conclusion, because we have seen that the best one is option 2. Honestly, option 2 is there, and option 2 is 12.56. You have to have 12.6%, which is high. We have 12.78 still high, 13 point, that is still high, 14% still higher than 12.56, and 15% is very, very high. So conclusion will be that option B is the best option to be used. Then you can just have your conclusion there based on calculation above. The best optimum structure, optimal structure is option 2, where the project is financed through, just to specify, where the project is financed through 300,000 rands. Let us check if it's 300,000 rands. Yes, 300,000 rands will be debt and 75,000 rands will be equity, which will be 300,000 rands debt and the 300,000 rands of debt, and that debt was 4 times by 75,000, and via a loan from Caps Bank, and 75,000, which is 1 times that by 75,000, through issuing of shares. Through issue of new shares. Then at this point, WACC is the lowest and therefore most efficient. At this point, weighted average cost of capital is the lowest and therefore more efficient, or the most efficient. The most cost efficient. That will be the answer to this question. Let me say, guys, thank you.